What if I told you that one handshake in May 2024 created a $22.5 billion oil giant that's now dominating American shale fields? While you were probably worried about gas prices, two massive oil companies were quietly orchestrating one of the biggest energy deals of the decade. This is the story of how ConocoPhillips swallowed Marathon Oil whole and why it matters way more than you think. I'm Rithwik, and this is the deal that's reshaping the entire American oil industry. The oil takeover. Before we dive into this corporate takeover, let me paint you a picture of what American oil looked like in 24. ConocoPhillips. Not exactly a household name, but absolutely massive. We're talking about America's largest independent oil producer, pumping out over 1.8 million barrels per day. Think of them as the Tesla of oil companies. Lean, efficient, and obsessed with shareholder returns. Then there's Marathon Oil, smaller, but still huge, producing about 400,000 barrels daily. They had prime real estate in America's hottest oil fields. The Permian Basin in Texas, Eagle Ford, and the Bakken in North Dakota. These aren't just any oil fields. These are the shale formations that made America energy independent. But here's the thing about the oil industry in 2024. It was all about scale. The bigger you are, the more efficiently you can drill, the better deals you get on equipment, and the more money you make per barrel. It's like Amazon versus your local bookstore, but with oil rigs. And while ConocoPhillips was already winning this game, they saw an opportunity to absolutely dominate it. So how does a $22.5 billion deal actually happen? It's not like buying a car. You can't just walk into a dealership and say, "I'll take that oil company, please." The story starts with ConocoPhillips CEO looking at a map. Marathon Oil owned assets right next to ConocoPhillips' existing operations. In oil, location is everything. It's like owning two neighboring coffee shops. You can share suppliers, reduce costs, and dominate the entire block. In early 2024, ConocoPhillips made the call. They approached Marathon Oil with what's called a friendly takeover, basically saying, "Hey, want to merge and make a ton of money together?" The negotiations were surprisingly smooth. By May 29, 24, both companies announced they had a deal. 6 months later, by November 22nd, it was done. In corporate terms, that's lightning fast. But here's what makes this deal fascinating. It wasn't a cash purchase. ConocoPhillips paid entirely in stock. For every Marathon Oil share you owned, you got 0.255 shares of the new, bigger ConocoPhillips. It's like trading your small house for a smaller percentage of a mansion. The entire process took just 6 months from announcement to completion. That's incredibly fast for a deal this size, which tells you just how eager both sides were to make this happen. Let's talk numbers, because this is where things get really interesting. $22.5 billion total deal size. To put that in perspective, that's more than the GDP of 100 countries. Marathon Oil shareholders didn't just get ConocoPhillips stock. They joined a money-printing machine. Within 12 months, ConocoPhillips expects to save over $1 billion annually through synergies. That's corporate speak for we can fire duplicate employees, combine operations, and make way more money. Harsh, but that's capitalism. The math is pretty simple. Marathon Oil was producing 400,000 barrels per day. ConocoPhillips was already at 1.8 million. Combined, they're now pumping over 2.2 million barrels daily. At $80 per barrel, that's $176 million in revenue every single day. But here's the real kicker. ConocoPhillips immediately raised their dividend by 38% and announced $20 billion in share buybacks over 3 years. For shareholders, this was like Christmas morning. The deal was immediately accretive. Finance speak for we're making more money per share from day one. No waiting, no hoping, just instant results. And remember, This was an all-stock deal. No debt, no cash changing hands. ConocoPhillips essentially printed new shares to buy Marathon Oil, then used the combined company's efficiency to make those shares more valuable. It's financial engineering at its finest. This deal isn't happening in isolation. It's part of a massive consolidation wave sweeping through American oil. Think about it. Exxon bought Pioneer Natural Resources for $60 billion. Chevron tried to buy Hess for $53 billion. Occidental bought Crown Rock for $12 billion. The entire industry is playing musical chairs, and when the music stops, only the biggest companies will be left standing. Why? Because shale oil is a volume game. The more wells you can drill, the better spoils you get on everything from steel pipes to sand. It's economies of scale on steroids. This ConocoPhillips Marathon deal creates America's undisputed shale champion. They now control premium acreage across the Permian, Eagle Ford, and Bakken, the three most productive oil regions in America. It's like owning Park Place, Boardwalk, and Mayfair in oil monopoly. For consumers, this consolidation could mean more stable oil prices. Fewer, larger companies tend to be more disciplined about production, but it also means less competition, which historically hasn't been great for prices. For the broader economy, it's complicated. On one hand, these mega-efficient oil companies help keep America energy independent. On the other hand, we're creating oil oligopolies that could have serious market power. The Biden administration's FTC took a hard look at this deal, issuing what's called a second request for more information. That's regulatory speak for "we're watching you very closely," but ultimately they let it go through. Here's what I think is really happening here. This deal represents the final maturation of America's shale revolution. We're moving from the Wild West days of hundreds of small oil companies to a handful of ultra-efficient giants. It's the natural evolution of any industry. Consolidation follows innovation. ConocoPhillips played this perfectly. Instead of paying cash and taking on debt like many of their competitors, they used their strong stock to make this acquisition. It's a sign of confidence in their own business model. But I'm concerned about the long-term implications. When you have fewer players controlling more resources, you reduce competition and innovation. These mega mergers might boost short-term efficiency, but they could stifle the entrepreneurial spirit that made American shale successful in the first place. From an investor perspective, this deal makes total sense. ConocoPhillips shareholders get immediate benefits, higher dividends, share buybacks, and a stronger competitive position. Marathon Oil shareholders essentially got bought out at a premium and now own shares in a much larger, more efficient company. The real test will be execution. Can ConocoPhillips actually deliver those $1 billion in synergies? Can they integrate Marathon's higher-cost assets without destroying value? History is littered with massive M&A deals that looked great on paper but failed in reality. So there you have it. The $22.5 billion deal that created America's shale oil champion. ConocoPhillips didn't just buy Marathon Oil. They bought dominance in America's most productive oil regions. They're now pumping over 22 million barrels per day, returning billions to shareholders and positioning themselves as the ultimate beneficiary of America's energy renaissance. Whether this is good for consumers, competition, or the broader economy remains to be seen. But one thing is certain. The American oil industry just got a whole lot more concentrated. What do you think? Are these mega mergers good for America's energy future? Or are we creating oil monopolies? Let me know in the comments below. If you enjoyed this deep dive into corporate America, hit that subscribe button and ring the notification bell. I break down the biggest business deals and economic trends that actually matter to your life. Thanks for watching, and I'll see you in the next one. Subscribe this channel for more such videos.